Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories in corporate filings, and today we're diving into SunHydrogen Incorporated's latest quarterly report. And let me tell you, it is a fascinating blend of ambition and the harsh realities of developing groundbreaking technology. So what is the big deal with this filing? Well, it is a deep dive into SunHydrogen's financial health and strategic direction, especially as they push forward with their ambitious goal of producing green hydrogen using just sunlight and water. Think of it as a progress report from the front lines of clean energy innovation. This is SunHydrogen Incorporated's quarterly report, a look at their financial standing as of the 31st of December 2025. It gives us a snapshot of where they stand, what they've been up to, and of course, how their money matters align with their big vision. Let's start with the balance sheet. This is like a financial snapshot of the company's assets, what it owns and its liabilities, what it owes at a specific moment. As of the 31st of December 2025, SunHydrogen had about $14.4 million in cash and cash equivalents. Now, that might sound like a lot, but compare it to about $34.6 million at the beginning of this period, the 30th of June 2025. That is a significant drop, nearly a 60% decrease. This tells us they've been spending money likely on research, development, and operations, which is expected for a company in this field. They also had a substantial amount in short-term investments, around $19.8 million at the end of the period. This is a big jump from the roughly $3 million they had at the start of the period. This suggests they might have had some successful investment activities or perhaps converted some cash into more liquid investments. Overall, the total assets for the company stood at about $34.5 million at the end of December 2025, down from about $37.9 million at the end of June 2025. This decrease in total assets is consistent with the decrease in cash, as expected. On the other side of the coin, their total liabilities were around $740,000. That is a relatively small number compared to their assets, which is generally a good sign. It means they are not heavily indebted. They also have Series C preferred stock, which has a redeemable value of about $516,500. This is a bit unique because it is presented differently, essentially as a liability because it can be redeemed by the holders. Now, for the part that often raises eyebrows for companies in development, the accumulated deficit. By the 31st of December 2025, this stood at a little over $103 million. This figure represents the total net losses the company has incurred since its inception. It is a common sight for innovative companies that are investing heavily in technology development before generating significant revenue. Moving on to the statement of operations, this is where we see how the company performed in terms of revenue and expenses over a period. For the 3 months ending the 31st of December 2025, revenue was zero, and for the 6 months ending the same date, it was just $1,250. This really highlights that SunHydrogen is still in the very early stages of commercialization. They are not yet generating significant sales. Operating expenses, however, were substantial. For the 3 months ending the 31st of December 2025, they spent nearly $1.7 million, up from about $1.2 million in the prior year's quarter. For the 6 months, expenses were over $3.5 million, up from about $2.3 million in the first half of 2024. A significant chunk of that expense is research and development. For the 6 months of 2025, it was over $2.1 million, a big jump from about $1.2 million in the same period of 2024. This spending is crucial for a company like SunHydrogen, aiming to perfect its hydrogen technology. The result of these expenses without significant revenue is a net loss. For the 3 months ending the 31st of December 2025, the net loss was about $1.5 million. For the 6 months, the net loss was approximately $3 million. While these are indeed losses, it is important to note that the net loss for the 6-month period actually decreased significantly from about $5.5 million in the prior year. A big reason for this decrease in net loss comes from other income expenses. In the prior year, there was a massive unrealized loss of over $4.1 million related to an investment in a company called Teco. In the current period, that loss is gone, leading to a much better reported net loss, even though the core operations are still losing money. This can be a bit misleading as it's not operational improvement but rather a swing in investment value. Let's look at the statement of shareholders' equity. This shows how the owner's stake in the company has changed. The additional paid in capital is quite large, over $130 million. This represents the money investors have paid for stock above its par value. It shows a history of equity financing. Again, we see the accumulated deficit growing, reaching over $103 million by the end of December 2025. Now, let's talk about cash flow. This is the lifeblood of any company, especially one in development. For the 6 months ending the 31st of December 2025, cash used in operating activities was about $2.3 million. This means their day-to-day business operations are consuming cash, which is aligned with their lack of revenue and significant R&D spending. This number is higher than the roughly $1.5 million used in the same period of the prior year, indicating increased operational spending. Investing activities show how the company is spending money on assets that will help it in the future. Here we see a significant investment of about $16.9 million for the 6 months ending the 31st of December 2025. This is a considerable outflow, likely related to acquiring assets or making strategic investments to support their technology development. This is a new activity compared to zero in the previous year. Financing activities show how they raise money, like through selling stock or taking loans. For the 6 months ending the 31st of December 2025, they used about $1 million, likely for the repurchase of Series C preferred shares. In contrast, in the prior year they had provided about $2.1 million, largely from selling shares under an investor purchase agreement. This shift from receiving financing to using cash for financing activities, combined with increased operating expenses, explains the significant drop in their overall cash balance. Digging deeper into the notes, we learn more about SunHydrogen's core mission. They are developing a way to produce green hydrogen using only sunlight and any water source. This is a big deal because most hydrogen today is made from natural gas, which is not environmentally friendly. Their technology works like a solar panel but generates hydrogen. They are also exploring a parallel path using commercially available solar cells, which could potentially speed up market entry. This dual approach shows a strategic attempt to balance their proprietary nanoparticle technology with leveraging existing manufacturing platforms. These are the accounting rules they follow. The key takeaway here is that the financial statements are unaudited. This means they have not been reviewed by an independent auditor yet, which is standard for interim reports, but worth noting. They define cash equivalents as short-term, highly liquid investments. The large shift in cash and short-term investments we saw earlier is quite pronounced here. Their cash decreased dramatically while short-term investments increased. It is good to see they are investing in relatively safe US Treasury bills, indicating a cautious approach to managing their remaining cash. SunHydrogen holds patents and trademarks related to their technology, which are listed as intangible assets. These are amortized over their useful lives, meaning their value is gradually written down over time. They explain how they recognize revenue, which is mainly from consulting services. As we saw earlier, this hasn't generated much income yet, with only $1,250 in revenue for the 6-month period. This reinforces that the company is still in a pre-revenue or very early revenue stage for its core hydrogen technology. The net earnings or loss per share is a tiny fraction, essentially zero for both periods. This is because they have a massive number of shares outstanding, over 5.4 billion shares by the 12th of February 2026. When you have so many shares, even significant profits or losses get spread very thinly, making the per share figure almost negligible. For context, if they made $1 million profit divided by over 5 billion shares, it would be less than 1/10 of a cent per share. They are also recognizing stock-based compensation, which is common for tech companies, essentially a form of payment to employees and consultants in the form of company stock or options. This is a non-cash expense. For the 6 months ending the 31st of December 2025, this was over $558,000. This section details their Series C preferred stock. It carries a 10% cumulative dividend, which is a significant obligation. It is also presented as mezzanine equity, meaning it is a bit of a hybrid between debt and equity, redeemable at a specific value. Interestingly, they repurchased some of this preferred stock for a much higher price than its stated value, costing them $1 million for stock valued at $148,600. This is a substantial premium and might indicate specific circumstances or agreements related to these shares. This is a really interesting section concerning their investment in a Norwegian clean tech company called Teco 2030 ASAR. At one point, SunHydrogen owned a significant stake and even had their CEO on Teco's board. However, Teco filed for bankruptcy and their shares were delisted. This resulted in SunHydrogen writing off the entire value of this investment, seeing the fair value plummet to zero. This highlights a significant risk in their investment strategy and a substantial financial loss from this particular venture. The report also mentions a subsequent allocation agreement involving a new company, Nuco, receiving shares in exchange for Teco's assets. SunHydrogen was to receive shares in Nuco for free. However, they are valuing this investment at cost minus impairment, which is currently zero. suggesting uncertainty about its future value. This table breaks down their investment income for the 6 months ending the 31st of December 2025. They earned around $653,000 from interest on cash and treasury bills and other small amounts. This is down from about $919,000 in the same period of the prior year, which is consistent with the decrease in their overall cash and cash equivalents. This section outlines future obligations and potential risks. SunHydrogen has several research agreements with universities like the University of Iowa, the University of Michigan, and the University of Texas at Austin. These involve significant funding commitments totaling hundreds of thousands of dollars across these agreements. These agreements show a continued investment in scientific research to advance their hydrogen technology, but they also represent substantial financial commitments. This section details transactions with individuals or entities closely linked to the company. They had a loan from their CEO, which has now been fully repaid. Importantly, it refers back to Note 7 for the significant related party activity with TECO and NewCo. This is where they disclose events that happened after the reporting period, but before the filing they received $500,000 for issuing new shares, entered into a $400,000 promissory note, and signed a technology and manufacturing services agreement with a third party. These are all important developments indicating continued activity and potential future growth. This is the management's narrative explanation of the financial results. They are very clear about their mission to replace fossil fuels with clean, renewable hydrogen, emphasizing the environmental benefits and cost competitiveness they aim for. They discuss their dual-pronged approach to technology development, emphasizing the need for cost, effectiveness, and faster market entry. Management highlights their reliance on estimates and judgments, which is standard in financial reporting, but especially true for companies dealing with complex technology and valuations. They explain that operating expenses increased due to higher R&D and administrative costs. The improvement in net loss compared to the previous year was largely due to that investment loss in TECO disappearing, rather than a jump in operational performance. Similarly, for the 6-month period, the reported net loss decreased, again primarily driven by the absence of the TECO investment loss. They generated a small amount of revenue from consulting services, a slight step up from zero in the prior year, but still very small compared to their expenses. This section dives into their cash situation. They acknowledge that their ability to continue as a going concern depends on raising capital through financing and future revenue. They've relied on equity sales and plan to continue doing so. The increase in cash used in operating activities and significant cash used in investing activities explains the decrease in their cash balance. The big takeaway here is that they are burning through cash at an increased rate, which is typical for a company in their stage, but also highlights their need for continued funding. This is a critical statement. It means the company's survival hinges on its ability to secure more money. If they can't find investors or generate revenue soon, their future operations are uncertain. This honest assessment means that the company's success is directly tied to its ability to attract more investment or to start generating significant income from its technology. Without that, continuing operations is a serious question mark. They detail an evaluation of their disclosure controls and procedures. They acknowledge a material weakness due to the inherent limitations of segregation of duties in a small company. This is a common issue for growing businesses. They've implemented additional review processes and engaged outside consultants to mitigate this. They have significant lease and research commitments for lab space and university partnerships, showing ongoing investment in their operational infrastructure and R&D. They state there are no new material risks, indicating that the existing risks previously disclosed are still relevant. This typically means they are exposed to the usual challenges of technology development, market adoption, funding, and competition. Finally, the management certifications. These confirm that the CEO and acting CFO have reviewed the report and believe the financial statements are fair. The fact that they are now acting CFO is something to note, perhaps a change in official roles. Now let's take a step back and look at the bigger picture with SunHydrogen. Their vision is incredibly compelling clean, renewable hydrogen powered by the sun. This is a massive market with huge environmental implications. They are putting their money where their mouth is, investing heavily in research and development, which is essential for any company trying to pioneer a new technology. However, the financial reality is stark. They are burning through cash at an accelerated rate. Their cash reserves have significantly decreased, and their net losses, while seemingly improving on paper due to investment value swings, are substantial. The reliance on future financing is a major risk factor, as their continued existence depends on attracting more investment. The right off of the TECO investment also shows the volatile nature of their investment strategies and the potential for significant financial setbacks. The dual approach to technology development is smart. It hedges their bets and potentially accelerates market entry, but it also means managing multiple R&D paths, which can be resource intensive. The significant commitments to university research are positive in pushing the science forward, but they also represent future cash outflows that need to be managed carefully. In my opinion, SunHydrogen is a high-risk, high-reward company. Their technology has the potential to be a game changer in the clean energy sector, but they are in a very early stage, and the path to profitability is long and uncertain. Investors betting on SunHydrogen are essentially betting on the successful development and commercialization of their hydrogen technology and their ability to secure continuous funding. The next few years will be critical in demonstrating progress and securing that much needed capital to bridge the gap from development to market. Alright, that is our breakdown of SunHydrogen's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives with Corporate Decoder. Don't forget to check out the Discord community linked in the description below for more discussions. Thanks for watching. See you next time.